Hey everyone, welcome back to Corporate Decoder, the place where we take those super long confusing company reports and turn them into something you can actually understand. Today we're diving into SMC Entertainment's latest annual report, and let me tell you, it's a wild ride. We're talking about losses, acquisitions, and even some preferred stock. Think of this report as a movie script. The title would be SMC Entertainment, a cautionary tale of AI and unfulfilled promises, and get ready for a plot twist. So what exactly does SMC Entertainment do? Well, in their own words, they see themselves as a fintech disruptor, seeking out businesses that are pioneering the digital world and investing in AI specifically within the financial services space. They're all about using computers and machines to mimic the problem-solving skills of human experts. They're really pushing their F1 AI platform, which includes something called the Finiti Global Equities EBT Index. Finiti, which SMC owns, focuses on developing technology for wealth management and capital markets. The goal is to provide AI-driven investing and trading. The IQ engine, which they've developed as part of this, analyzes a ton of financial data, looking for trends and patterns. Basically, it uses machine learning and AI to help make decisions about trading, asset allocation, and managing risk. They pull data from all sorts of places: real-time market prices, economic indicators, news articles, company financials, and even alternative data like buy now, pay later tracking and credit card usage. That mix is designed to provide actionable alerts to financial institutions. Now, here's where things get a little dicey. The report mentions something called substantial doubt about the company's ability to continue as a going concern. Basically, their auditors are worried about whether they can stay in business. Why? Because they've been racking up losses and haven't been profitable yet. They depend on raising capital to keep things going. In recent years, SMC has been making some moves. They acquired Finiti Global Equities in early 2023. They also had an acquisition agreement with Bateau Asset Management, an Australian investment manager, completed in January of 2025. But not all acquisitions go as planned, you'll see. The report lays out some pretty serious risk factors. One of the biggest is that they are not profitable and may never be. They talk about needing more capital, which might be hard to raise. They also admit they haven't adopted various corporate governance measures, which could leave stockholders with limited protections. There's also the risk of cybersecurity breaches, which could really harm their business. And like any tech company, they face the risk of not being able to protect their intellectual property. The report also warns that the stock price may be volatile, which basically means it could go up and down a lot and you could lose your investment. They also mentioned that future sales of their stock could depress the stock price. Plus, because their stock is considered a penny stock, it might be hard to buy or sell. But they are taking cybersecurity seriously. They have implemented and maintain a risk management program that includes processes for the systematic identification, assessment, management, and treatment of cybersecurity risks. They implement a risk-based approach to manage cyber threats. Their common stock is quoted on the OTC markets pink. It is very thinly traded, and the price may not reflect their value. The ability of individual stockholders to trade their shares in a particular state may be subject to various rules and regulations of that state. Now let's get into the numbers. They didn't have any revenue for the year of 2024, same as the previous year. General and administrative expenses increased slightly. However, compensation to related parties decreased. Digging deeper, there's a significant increase in the net loss. This is mainly due to some transaction expenses from an abandoned acquisition. Let's take a moment and think about it. That is, SMC lost a total of $8,483 to begin with, and $593,558 and 3 TBA versus significant increase in the net loss. This is mainly due to some transaction expenses from an abandoned acquisition. Let's take a moment and think about it. That is, SMC lost a total of $8,493,558 and 33 versus only $1,493,550,540.93 and $550,540.93,500. And to think about it, that is SMC. Looking at cash flow, the company's net cash used in operating activities is roughly the same as last year. The primary cash inflows were net proceeds from loans payable. In order to improve their liquidity, they plan to pursue additional equity financing and shareholders' loans. As of the end of 2024, they had about $11,000 in cash. Here's the really scary part. The company's convertible debt has exploded, with their total liabilities now over $11 million. There's a whole lot of convertible notes. This means there's a lot of potential dilution headed investors' way. Remember that acquisition of ChainTrade? Well, the company abandoned this acquisition due to non-performance of the seller. According to the report, they are now working to relieve themselves of this obligation. This led to significant expenses to the tune of 8 million and makes a large part of their losses. This is also by far the biggest reason for the company's balance sheet liabilities exploding. The accumulated deficit ballooned to over $26 million, with total stockholders' equity in the negative. These financial statements have been prepared assuming the company will continue as a going concern, and this creates a lot of uncertainty for SMC. Management plans to provide for the company's capital requirements by continuing to issue additional equity and debt securities. This is an ongoing theme in the report. There are some key events after the end of the year. They did close that acquisition agreement with Bateau Asset Management. Adam Yang resigned as CFO, replaced by Eric Sherb. It also turned out that the former ChainTrade assets are under a lot of scrutiny with legal action. But hey, at least the CEO and CFO signed off on the accuracy of the report. So what's the story here? SMC Entertainment is trying to break into the AI-powered fintech world, but they're facing some major headwinds. The report paints a picture of a company that's struggling to stay afloat, with massive losses, a ton of debt, and serious doubts about its ability to continue as a going concern. The biggest weakness for SMC is definitely their financial instability. The fact that their own auditors are questioning their ability to stay in business is a huge red flag. They're relying heavily on raising capital, which is never a great long-term strategy. But the push toward AI, although risky, could present some opportunities if they can pull it off. The abandonment of the ChainTrade acquisition was a major setback, costing the company millions. It's a reminder that not all deals are created equal, and due diligence is key. The report leaves you with more questions than answers. Can they turn things around? Is their AI technology truly innovative or just hype? Will they be able to find a way to become profitable? Thanks for tuning in to this episode of Corporate Decoder. If you found this breakdown helpful, give us a like, leave a comment, and subscribe for more deep dives into the world of corporate finance.